There is a new world out there which we are not involved with, and it is based on Chinese yuan that will become the principal currency replacing the dollar. And at some stage, it will be guaranteed by gold.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 2nd through June 9th, 2025, while supplies last. First this week, we feature backdated 1/10-ounce gold maples at just $39.99 over melt. Next, the very limited 1-ounce silver Engelhard Prospector rounds from 1982 to 1986 are just $4.79 over spot. 1-ounce silver Asahi bars are just $2.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this distinguished returning guest. Alasdair Macleod, a former bank director and former head of research, is now his own owner of a substack channel. He'll talk to us about that. But he also is going to talk to us about China seizing the control of the physical gold market and opening up that to both the world as well as storage facilities to take control of the gold away from the COMEX. Alasdair, thank you for joining us here on Liberty and Finance.
That's my pleasure.
I should mention to everyone, we're recording this on Wednesday, June 4th, 2025. You've been doing some research into and have made references a couple of times recently to some new warehouses, gold warehouses that China is opening up in different key locations strategically around the world. And you've added to that recently observations about their involvement in inviting global participation from other countries outside China in their gold exchange in Shanghai. Can you talk to us more about those details and the implications of it in your view?
Yeah, I think, for a long time, China has had the view that the paper currencies of the West would eventually go to zero. This, if you like, stems from the Marxist universities who, in China, who basically condemned capitalism, reckoned that capitalism would destroy itself. And indeed, Marx himself saw capitalism as being, if you like, no more than a stepping stone to the final, his final nirvana, as it were, of a world which is controlled by the state, in effect, on behalf of the workers rather than by the bourgeoisie.
Well, of course, on behalf of the workers, always.
Absolutely. So, China started off with this, when Mao Zedong died, this thought, if you like, was behind the appointment of the People's Bank of China to act not only for all the foreign exchange transactions, along with the SAFE fund, which is sort of seen as a sovereign wealth fund, which is underneath the control of the People's Bank of China, but also in 1983, regulations were produced by the Communist Party appointing the People's Bank with sole control over the nation's gold and silver programs. And it was clear that with that big bear market that we had between 1980 and, this started in 1983, in effect, between then and the year 2000, 2002, there was a lot of gold coming out on the market, these were the conditions under which the People's Bank of China was able to accumulate substantial undeclared quantities of gold bullion. By 2002, obviously the People's Bank of China and the Communist Party reckoned that they had got enough gold to secure their currency in the future. And so at that stage, they opened the Shanghai Gold Exchange and allowed ordinary Chinese citizens to accumulate gold. Until then, they'd been banned from owning it completely. Since then, Chinese nationals have taken delivery out of the vaults, the SGE's vaults, of around about 27,000 tons. Now, some of that would have probably gone back in as scrap, because anything which is resubmitted to the vaults, if you like, is scrapped and then recast. But on top of that, there is quite a lot of gold which is actually owned by banks and also ETFs and other investment funds, which are stored within the Shanghai Gold Exchange's vaulting system. So, we're looking at very substantial quantities of gold. And I reckon that by 2002, I reckon the state had probably accumulated around about 20,000 tons of gold. And also bear in mind that they invested a lot of time and effort into both refining gold and also mining gold. And they quite rapidly became the largest gold mining nation in the world, and have held that position for, 15 years now? 10, yeah, it must be about 15 years. So, and the other thing is, of course, we've seen gold go from the west to the east. I mean, this was, a story which is that's 20 years old, that story now. So there's an awful lot of gold has gone into China. And not only that, but nothing comes out of China. I've spoken with directors of the Swiss refiners, asked if they ever see any Chinese refined bars. And the answer basically is no. There was a report of a few bars turning up, and it was thought that those were smuggled out. But, basically it's Hotel California for gold. So there's an awful lot of gold, both owned by the state and also owned, and not declared as reserves, incidentally, owned by the state and also owned by Chinese nationals. So how much it comes to, I really don't know. But you can see that China has a huge interest in the price of gold, if you like, and she has a huge disinterest in the dollar. So really what she's trying to do is she's trying to run, with Russia and Shanghai Cooperation Organization and BRICS, all these parties, she's sort of, if you like, dividing a world into a sort of schism between East and West. And the one thing she wants, if you like, is control over the settlement means for all the commodities she buys, the things that she imports and the things that she exports. And so she wants to do away with the dollar. And part of this is having control over gold markets. And that is why, it's one very good reason why anyway, that now that she, is de facto controls the physical gold market, she now wants to take away, if you like, the paper control, which is very, very much a dollar story. So that's one aspect of it. The other aspect of it, if we go back to what the Marxist universities taught, the Chinese students about how the capitalism would destroy itself. Well, obviously, it destroys itself. The currencies get destroyed, particularly if they're not attached to gold. In other words, if they're just fiat currencies, they will go down the Swanee River as well as capitalism. Now, we can see the conditions whereby this is now going to happen to the dollar. Now, I think as far as the Chinese are concerned, they've expected this. This doesn't surprise them at all. But the election of President Trump, as far as the Chinese are concerned, is accelerating the process of the death of the dollar, simply because he's a spendthrift. We've got that big, beautiful bill going through at the moment, which will probably add, take that budget deficit up to something like 2.5–3 trillion. You've got an economy which, really, when all is said and done, is not behaving very well. It's probably in recession. And it is particularly in recession if you take out government spending. In other words, it's only government spending, unfunded government spending, which is actually giving the illusion of an economy which is growing. Take that out, and you've got a contracting economy. And it's been like that for a few years now. Now, this matters because of all the debt which has got to be funded. And you're going to see interest rates rise. And this is why at the long end of the US Treasury market, nobody can really raise anything out of it. I mean, the government has auctions and they sort of continually disappoint or fail or whatever. So foreign investment, if you like, in dollars, I mean, they've got too many dollars. They don't want to have any more. If anything, they want to sell some. They want to reduce their exposure to the dollar. And it's not just China. I mean, most of the countries, if you like, in the sort of Russia camp, see the dollar as a weaponized currency. They would rather not have, if you like, the risk that the dollar exposes them to. So you can see that the dollar is on a very slippery slope. And of course, this is why gold is rising. It's not so much gold rising, it's the dollar going down. But as far as China is concerned, they need to protect their own currency from a collapse of the dollar, which is becoming more imminent. And I think that informs their recent moves, which basically are they've said that they will open, or at least the Shanghai Gold Exchange, which is completely under the control, incidentally, of the People's Bank of China. They've said that they will open a vault in Hong Kong, and they have also said that they will open a vault in Saudi Arabia. Saudi Arabia, why? Because Saudi exports a lot of oil to China. Saudis want to be able to trade yuan for gold and gold for yuan. I mean, quite obviously, because of their trade. And I think you may well see other ones, other vaults being opened. This is all part of the internationalization of the yuan. And then only, last week or 8 days ago or whatever, it was announced by the Shanghai Futures Exchange that they would open up the futures exchange in Shanghai to foreign participation. Now, a foreign bank can deal on the Shanghai Futures Exchange at the moment, but it has to do it through a Chinese entity. That is all going to go. So, and this is obviously not just gold and silver, it's also base metals. There was the nickel problem, if you like, in London when a whole load of trades had to be cancelled by the London Metal Exchange. That was, a bit over a year ago now. So they want to take control over all this, if you like, at least to their advantage. Now, I think that one of the points behind the internationalization, if you like, the mobilization of gold as part of a trading situation, if you like. I mean, trading not fixed at this stage to the yuan, but obviously trading alongside the yuan at some stage. When the dollar really does start collapsing, I think you will find the Chinese are in a position to immediately announce a fixed exchange rate between the yuan and gold in order to stop their own currency sliding along with the Western currencies led by the dollar. So I think this is all after President Trump's Liberation Day. I mean, bear in mind that the reaction from the Chinese was uncharacteristically quick. The first announcement that came out was that they were going to speed up the negotiations for a free trade agreement between China, Japan, and South Korea. And then this was rapidly followed by President Xi visiting some of the leading ASEAN nations, which are basically the other nations, if you like, in Asia, in Eastern Asia. I mean, I think I can't remember, he went to Myanmar, he went to Vietnam, he went to Malaysia rather, and I think he went to Thailand as well. So now this was quick. Now, I'm fairly sure that the conversations that he was having was really about very quickly establishing a plan B, if you like, when America, started raising all these tariffs, this tit for tat tariff sort of thing. China needed to protect herself. She needed to secure her regional market, if you like, and that's what that was all about. And so this move on gold, I think, is in some senses an extension of that. And I'm sure that President Xi would have said to some of the leaders in these ASEAN nations, we're quite happy to sponsor a gold vault so that we can trade in yuan and we can trade in gold, whatever you like. I mean, this would be particularly one of the countries he went to was Vietnam. Now, the Vietnamese do use gold for ordinary settlement. I mean, you buy a house in Vietnam, you use gold. So, you can see the links, if you like. I may be joining the dots too much, but to my mind, it is actually quite clear that there is a new world out there which we are not involved with, and it is based on Chinese yuan. That will become the principal currency replacing the dollar. And at some stage, it will be guaranteed by gold. And that, I think, is very, very important to understand.
You've covered so much ground there. I want to circle back to a couple of the points you made. One was about this flurry of concerted activity that's been going on now for several years and coming to a crescendo perhaps here of Eastern nations emphasizing, taking very seriously the role of gold in the future of their financial dealings and their monetary dealings. Why, in your view, as a former London bank associate, you were a director of a bank, you had lunch with people in the London banking scene for quite some time. What is your view currently of why the Eastern world seems to be headlong, moving in very real and meaningful and material steps to take gold seriously, whereas the Western governments give every appearance of minimizing, diminishing, ignoring the role of gold in the future of their financial and monetary lives and that of their citizens?
Yeah, I think it's mainly a question of culture. In the UK, we had John Maynard Keynes, who had great influence in the UK Treasury and also, therefore, in other institutions such as the Bank of England. And the Bank of England was very much involved, for example, with other central banks like the Reserve Bank of India. I mean, I think the Bank of England is still consulted when it comes to appointing the governor of the Reserve Bank of England. So you can see that this sort of Keynesian influence has been extremely strong the whole way through, and it's something which I think has also, if you like, corrupted the Fed, if I can put it that way, and other European banks. I mean, they all talk to each other, and you've got this sort of, you've got the sort of top banks, and they sort of basically try and run things. And so they think the same way. And so you've got a very, very sort of Keynesian approach to it. But if, let us say, you're the Polish, very good example, the Polish central bank, you haven't been exposed to this, really, because it was only in 1989 that your country got independence. Until then, the zloty was just a rubbish currency. But things have actually changed quite a lot. And so they look at it rather differently. I mean, I remember central bankers, I can't remember, it was in the Czech Republic, I think it was one of the ones I knew. While the Czech Republic was having, the central bank was having one view, I was discovering that people within the central bank were having a completely different view. And you had Jens Wiedemann in the Bundesbank, who understood gold completely, and I think was instrumental in trying to get some of the gold back from the New York Fed. So, there are central bankers throughout the system who do actually understand the importance of gold. But where the new central banks are concerned, they haven't had this indoctrination to the same degree, this Keynesian or monetarist indoctrination. Call it the macroeconomic indoctrination. And so consequently, they see fiat currencies as being risky, which if according to those of us in the West, I mean, the least risk is actually to own U.S. Treasuries, but and not only that, but I know that if you try and talk to economists about what a currency is, they see it as money, not credit. They don't actually understand, and I'm talking about economists who you and I would think should know better. I'm not talking about the Krugmans of this world. I'm not going to mention any names because I have come across a few of these guys who think that the dollar is money. It's replaced gold. It's as simple as that. They don't actually understand the difference between money and credit. Whereas, when I was a young man, I remember in the Middle East, the Maria Theresa dollars were in circulation. These were silver dollars, and they were circulating throughout the Middle East, used as money, particularly by the Bedouins. I'm only talking, about 50, 60 years ago. So, there is, if you like, a different world out there. There's a world out there that understands that metallic money is actually money without counterparty risk. And you can own a Maria Theresa dollar or, a gold sovereign or whatever it might be. And that, if you like, is yours. And there is no risk attached to it. And furthermore, nobody knows you've got it until you actually come and try and spend it somewhere. So there is this fundamental difference. Now, if you want basically what these guys are doing, they're not buying gold so much. They're getting the hell out of fiat currencies because they understand what a fiat currency is. We've forgotten. This is the important thing. And I think, if you go to the Bank of International Settlements, of course, they're appointed really. I mean, people like Carstensen, are appointed by, in effect, the major central banks. So we're looking at the Fed, the Bank of England, the Banque de France, obviously the Swiss National Bank, and various others. And there's a sort of consensus, and the consensus comes out maybe not completely anti-gold, because the BIS does actually understand that gold has a major role, if you like, in financial markets. They argue a bit about how it should be categorized, and this is the Basel subcommittee, but they seem to have sort of vaguely agreed on that now and accepted that gold is an important asset, if you like. But the rest of the world, like the Russian central bank, the People's Bank of China, and so on. All those banks. I mean, they're Johnny-come-latelys in this macroeconomic game, and they don't play it the same way. I think that's the best explanation I can give you.
It almost seems to mirror the disconnection from grounded reality that has persisted and prevailed in the last decade in the West about DEI policies. It's like it doesn't matter how capable a potential airplane pilot is or a member of the armed services or whatever, as long as they meet certain intellectual narrative criteria that are arbitrarily established, as though you can just make up reality. And perhaps one of the places that hits the fan is in, you mentioned failed or failing bond auctions. We have a question because if your bonds are being rejected by those who are grounded in reality, then maybe the jig is up and someone's saying the emperor has no clothes on after all. We have a question from a viewer, Mr. Booch526 asks, could you elaborate on what constitutes a failed bond auction and what the second and third order effects might be?
Well, it rather depends, I think, on how the auctions are run. But basically, if the auction, let's say, is disappointing in terms of demand and, the tail and all these sort of things, then that would be seen as a failure, if you like. I don't think there's any point in going into too much into that sort of, if you like, the technicals of it. But the problem really is there's a misunderstanding even in the markets about the price of credit, if you like. They don't seem to understand that we're in a situation where credit it's increasingly risky. So, what does a foreigner do? I mean, does he sort of think that 4.5% yield on a 10-year US Treasury is a good idea? Does that attractive to him? Well, I mean, what he's going to do is he's going to look at this US Treasury and think in terms of, what's the risk if I go and buy these damn things? And if the risk doesn't, isn't covered, if you like, by the reward, he's not going to buy them. So the signal that's being sent by bond market failures is that the rates are too low. The rates have got to rise. But then there is another problem, Dunnigan, and that is that as rates rise, for countries which are in a debt trap, and I'm looking at America here, amongst others, incidentally, it's not the only one, then higher rates basically make the situation even worse. So you've got a situation really where almost no interest rate is going to compensate an outsider for the risk of holding US Treasuries. You've got, at the long end, you've got institutions who do require actuarially longer maturities, pension funds, for example, insurance companies which write a certain type of business, that sort of thing. But really, for the vast bulk of foreign investors, I mean, they're taking a risk buying into a foreign currency, given that there is a mismatch between the currency they account in and the currency they've invested in. And they're looking at this from the point of view of, well, what's my risk on this? Am I going to make money on it or not? It's actually as simple as that. And, the answer is that if you've got a currency which is risky, and this risk is we're beginning to see more and more risk, with the big, beautiful bill and all the rest of it, then you kiss goodbye to the idea of lower interest rates. Well, I mean, the Fed can lower interest rates, but they're not going to sell any more bonds. Because all that will happen is that the bond yield curve will just go, stand on its head. I would say forget cuts in interest rates. I mean, I was reading a headline today that, some statistic came up which suggested that, the economy isn't growing or whatever, the normal sort of stuff. The bond yields eased on the theory that this means that there would be more than 2 cuts in interest rates this year. The Fed would be able to, come on. They just don't understand. They just don't understand risk. And this is actually quite frightening. The whole market is being wrongly priced. And there will be a moment of discovery, and it'll be extremely painful when it happens.
A couple of aspects of what you're describing of the real risk of institutions or individuals investing in U.S. Treasuries, two things come to mind right away. One is the false statistics, financial statistics that are published, the headline statistics that are published by the U.S. government about the real cost of credit versus the real destruction of the currency in their fake inflation numbers. And you can maybe touch on that it seems that the Eastern Bloc nations see right through there. You can't pull the wool over their eyes by saying, oh, look, you've got a positive 4.5% yield or whatever, when actually it's a negative yield because the purchasing power of the dollar is going down. That's the value destruction story that would make you want to dump dollars. The other is the volatility. If you could also touch on that, because it's been said that for the first time in perhaps a long time, the volatility of the U.S. Treasuries has become greater than the volatility of gold, for example. And that's perhaps part of the indication, the evidence leaking out that there's everything's not so well underneath the hood of the Western financial credit-based edifice.
Well, I mean, there's volatility in financial markets. I mean, that's a fact of life. I'm interested that you say that the view was that gold was volatile. But
Well, I want to specifically make a mention there because you mentioned insurance companies needing long-term matchup of their risk versus the assets that they have, which makes perfect sense. Yeah. In speaking with some endowment managers, that sort of thing, we actually had wording replied to us, and I don't know if I read it to you or not in the past recently, that that gold is a speculative and volatile investment which pays no yield. Therefore, it does not meet the prudent investor requirements of law that these shepherds of funds are responsible for stewarding. And I thought that was worthy of a rebuttal.
Well, I mean, gold. One of the problems is that gold is not a regulated investment, so the regulators don't like it. Full stop. That's one aspect. The other aspect is that if you're an insurance company, you've got two sources of income, basically. You've got the premiums that come in, and you've got the returns on your investments. And basically what you do is when the returns on the investments go down, you raise your premiums. When they go up, you can lower the premiums. That's a relationship. So, but always it's a return. It's an income return, if you like, on bonds or on dividends. If you've invested in a company that pays dividends, or if you like, the total return in the equity market. So, gold, if you like, doesn't really figure in any of this whatsoever. This is a pure currency thing. Banks aren't interested in holding gold either. I mean, because why? A bank is a dealer in credit, for goodness sake. It basically what it does is it creates loans out of thin air to yield X and takes in deposits at zero. Or if it has to balance its books, it might pay, X minus Y to the poor depositors. So, it's all dealing in credit. That's the whole thing. And when it comes to thinking that gold is volatile, actually what's happening is it's the currency underlying, which you're measuring it in, which is responsible for much of the volatility. Not all the volatility, because the value of gold rises and falls depending what you measure it against. I mean, if you measure it against the price of, I don't know, nickel or copper or something like that, obviously the price is going to rise and fall. But over very long periods of time, you'll find that a basket of metals, will retain its value. And before, I've shown charts, which actually was first put together by James Turk of West Texas Intermediate Oil from 1950 to today. At the times when it's gone up, I mean, it started off, I think it's something like $2.53 in 1950. It's been up to $140. It's been horribly volatile. It's currently 60 and change. And where is it in gold? In fact, the value of oil in gold has declined. It's down, I think it's down around about 40% from that 1950 price. So, that is actually a lot less volatile than measuring commodities, the things that we actually need in fiat currencies. And when you look at sort of wholesale price indices and all the rest of it, I mean, the story is exactly the same. It's currencies going down the whole time, not gold. Gold is, if you like, a representative of all those things together. I mean, it's the general price level is a concept. You can't actually sort of say that you can really measure it. But if you look at the purchasing power of any fiat currency, I mean, that's where the volatility is. It's just gone down and down and down and down. If you think going down on a smooth path isn't volatility, then I think we'd probably differ a little bit in our definitions.
You've also mentioned the Eurozone being joined at the hip, at least from a banking organizational standpoint at the BIS, with the Western, like the US and so on. Eric Jantis says, what future does Europe have without American military presence, no gold, and provoking war with Russia?
Well, Europe actually, I mean, the European central banks do have quite a lot of gold. I think that the statement about gold needs to be modified a bit, if you like. I mean, we're really looking at a geopolitical situation now, I think, rather than a monetary situation. It actually does worry me. The Europeans, now that President Trump, I think, has very sensibly backed off from this Ukrainian situation as a dead loss, if you like, as a failure of American policy, particularly American policy, because they've used NATO, if you like, as the bridge to try and drive Russia out of business through Ukraine, through a proxy war in Ukraine. The Europeans, who originally sort of seem to show some understanding of where the Americans were in this. I'm talking about the Orange Revolution and all the rest of it, going back to 2014. They now are supporting the Ukrainians and getting drawn into something which seems to me to be coming out of control. And we've had this thing of 18 months of planning by special forces, taking out all these, nuclear-capable aircraft, bombers, and all the rest of it. Now, I was fascinated to see an article in one of our main newspapers by a guy called, I think it was Tim Collins, who was a special forces guy, writing about this, and reading between the lines, I think it's quite possible that our MI6/SAS might have been involved in the planning of that. It could be that the CIA was involved in it. But if that's the case, I mean, looking at the statement that came out of the White House, was it yesterday, when this happened? The answer basically was that the Ukrainians had not given Trump any warning on this. Now, it's possible that he might have been given the warning not by them, so he could deny that, but by the CIA. But he sort of changed things around quite a bit for the CIA, and they would have been going against President Trump's orders if they had pursued with that one. So I think we British might be involved with it. I'd be very worried about it, actually, because we're now rearming, rearmoring. We're spending an awful lot of money, we're trying to get this through Parliament to spend 3% of our budget on defence and all the rest of it. The way in which this is being sold to the public is, we've got to defend ourselves from that nasty Mr. Putin. This is actually a situation which I think is intensely political and extremely concerning and could escalate out of control. So I am worried about this. And the Europeans, they're like headless chickens. I mean, without being steered by America, because, I mean, NATO's basically been run by America, and we're just the yes men, if you like. I'm talking about Britain. Now you've got, NATO is just a shell into which is stepping Germany. We've got huge, great economic problems, which traditionally can be defrayed through war, taking the attention away from the domestic front. You've got France, which is a mess. They're also taking the same view. And you got Britain. I mean, with a Labour government which actually just hasn't got a clue about what they're doing, and they're flim-flamming this way, that way, and everything. I think it's a recipe for disaster. I really do. So I am actually quite worried about Europe without America, because there's not a lot I've got to say which is good about President Trump, but his recognition of the error, if you like, of trying to use Ukraine through a proxy war to attack Russia, that has failed, and he's trying to back off out of that. And this isn't our game at all. It really isn't. And I think our leaders are just making a huge, great mess about it. I really do.
Another aspect our viewers are particularly concerned about is the imposition of authoritarian control over their lives by governments, perhaps most notably in one way, central bank digital currencies, which reputedly are coming to a head soon, perhaps to a euro near you. We have two comments related from two different viewers, if we can touch on these before we wrap. Stephen Edmonds says, Andrew Slay has claimed that Christine Lagarde has told all European governments to make sure they have their CBDC ready to go for October. Have you heard of this? Related question from Anthony Shepard, who says, the European Union has been slowly instituting capital controls over people's currency and bank accounts, with the latest example being Spain. Christine Lagarde is replacing the euro with CBDC this October, which will facilitate total control of Western Europe's financial and monetary systems. If this happens, what will be the people of Western Europe's reaction to another authoritarian, totalitarian system?
I think it's extremely interesting points raised there. I'm not aware that the October date is definite, but certainly from Lagarde's comments, that is the direction in which she is going, yes. And in Spain, we've got a far left government, which is clamping down on virtually all spending, if you like. I can't remember the levels, but something like 3,000 euros has got to be reported, and I mean, it's just, it's just getting crazy. I mean, I think that basically Europe is drifting into complete anarchy. I just don't see that the French people, for example, or the Spaniards will put up with this sort of thing. I think that, I mean, the French certainly have a history, if you like, of really rioting against their government. I think we're going to see that increase again. I am aware also that in Germany, the sort of, we don't get this sort of opposition whereby we oppose, but we respect the government, and therefore, while we oppose it, we don't go out and burn things and set fire to things and kill people and all the rest of it. Germany is actually a bit different on that. While I think that the AfD in Germany have got the right ideas in terms of direction and in terms of controlling immigration, which is a big, big issue in Germany now, I fear that, at the street level, you're going to get some pretty nasty things happening. So all in all, I think that these monetary changes, the CBDCs and all the rest of it, which actually is inflationary. I mean, it's just another form of fiat currency. It's just extra inflation. I think that I think that Europe is in a huge, great mess, and of course, a number of countries are in deep debt traps. Italy, for example, debt to GDP of 140%. Spain is about 100. France is about 110, something like that, I think. And in Britain, we're about 105. We're trying to control it. I suppose that's one thing that we are trying to do. But we're trying to control it basically by stifling the economy through higher taxes rather than cutting spending. And that's actually, I mean, it's the problem that our Chancellor of the Exchequer has is actually all around Europe. It's also in America. No politician has the guts or, if you like, the mandate to cut public spending. So what do? They just tax us to hell and gone. And how does the economy go? I mean, well, the answer is that you cover it up because the purchasing power of the currency collapses or it goes down. You get more currency in circulation, and that's called an increase in GDP. It's fine as long as you can keep a lid on prices. I talked to John Williams about that.
Oh, yeah. Follow-up question here from Anthony Shepard. Will the rollout of CBDC starting in Europe then happen in the United States at that same time or shortly thereafter? And what would be the impact of having physical gold and silver in your own possession to circumvent that system?
I don't see CBDCs rolling out in America. It doesn't make any sense to me whatsoever. And I think also that the major banks, I think, would be against it. I guess that CBDCs, they can't be brought in by executive order or anything silly like that. I think that's a matter for Congress. And virtually every member of Congress is bankrolled by a bank somewhere along the line. I just don't see it. I don't see it passing muster. The Bank of England wrote a white paper on the introduction of CBDCs. And basically what they said, and this could well happen in America, is that if we have a CBDCs, then it's going to take quite a long time for this to come in, because you've got to sort of get the software working and all the rest of it. It's got to be absolutely foolproof. What the Bank of England would do, rather than, let us say, doing what the Bank of England, a Bank of International Settlements committee reckoned, and that is that we have direct accounts with the central bank as individuals and businesses. The Bank of England said, no, we won't do that. We will delegate that to the commercial banks. So the commercial banks basically will offer you two forms of credit, one of which is a CBDC, and the other of which is a normal loan account, overdraft or deposit facility or whatever. So, in a sense, I don't know that I'd mind that terribly, if you like, from the point of view of someone who banks with a commercial bank. It's just a bit more choice. But as far as the government is concerned, I mean, if they start trying to use CBDCs as a means of stimulating this part of the economy or that part of the economy or whatever, I mean, it's going to be an absolute disaster.
So for people who want to follow your writing on an ongoing basis, how should they get connected?
I run the Substack, as you very kindly mentioned at the start of this. So it's alasdairmacleod.substack.com. If you could put that on your underneath the video, then
yep, we'll put it in the link.
Hopefully, the spelling of my name won't be a hurdle. And really, I mean, the theme of it is education, really, to counter the disinformation that governments give you about what is money, what is credit, the role of government. If you like, what they do with statistics, which is actually just to mislead everybody for the advantage of the government. So it's about education, and really, I just want to convince people that there are huge, great dangers out there which they've got to recognize. Biggest credit bubble in history. When that goes pop, make the South Sea bubble look like a chimpanzee's tea party. I mean, And of course, we've got the tariffs, Smoot-Hawley Mark II. This is exactly what we had in 1929. It's the only thing to do really is just get the hell out of credit. And so, my Substack's really devoted to explaining why, so that people have got a chance of actually preserving their wealth. I'm not talking about increasing their wealth, because I think that game's over. I really do. You've got to preserve what you've got, look after what you've got, rather than try and speculate to accumulate.
Well, back in 1929, as bad as that crash was, most people had some gold or silver in their pocket, and now very few do. Alasdair, thank you again.
Yeah, well, the other thing I should mention is, of course, we had a gold standard then at 20.67 to the ounce until 1934, January 34 anyway. So you could actually have dollar bills, and they were secure until the gold was confiscated in 33, and then you had a 40% devaluation.
But it's probably for the good but it was for the good of the people, right? So we'll talk more about that in our next visit, and we're so grateful for your presence here always with us, Alasdair. Thank you.
That's very much my pleasure.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 2nd through June 9th, 2025, while supplies last. First this week, we feature backdated 1/10-ounce gold maples at just $39.99 over melt. Next, the very limited 1-ounce silver Engelhard Prospector rounds from 1982 to 1986 are just $4.79 over spot. 1-ounce silver Asahi bars are just $2.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.